Good evening all. Myself CMA-WIRC and along with CMA Ashish Bhavsar, welcome you all for this series of webinar on income tax. Today is the fourth session of our series. The today's topic is income from other source. The speaker for the entire series is CMA Amit Shahani. Sir, since the today's topic is income from other source is a small topic, what we will going to do, we will also try to cover some of the practical aspect from session 1, that is the income from salary to income from other source. That will also benefit you. So now I will hand it over to the CMA Amit Shahane sir to start the session. Before that, I will request all to fill the Google form which will be sent to you in chat box. The link will be available in the chat box. And also you please mention your name and membership number in chat box. Amit, over to you.
Yes, sir. Thank you very much, and thank you WRC for giving this opportunity. As rightly mentioned by Vinay Kulkarni sir, today we are going to discuss about income from other sources. In fact, in the last session, I did mention that it was income from business and profession. So time was a constraint because practically to cover entire business and profession in one session was a challenge for me as well as for the audience to digest all the provisions. So I had changed my approach slightly. Now today we have a slightly different situation wherein we have a relatively small topic and which is typically a residual section, I would say, or residual head as far as the 5 heads of income is concerned. In order to have a better audio quality, I would like to keep my video off so that the audio quality will be better. And I'll start with the presentation. I hope the presentation is visible to all.
Yes, go ahead.
Yeah. And my voice is also clear?
Yes, yes.
Yes, thank you. Thank you for the confirmation. Yeah, so income from other sources. Now, there are total 5 heads of income, as you are aware: income from salary, income from house property, income from business profession, capital gain, and income from other sources. Out of these 5 heads, of course, we'll be covering the 5th head today. And out of other 4 heads, in this particular series, we have already covered 3 heads, that is income from salary and business profession, and capital gain is will be discussed in the next session. But yes, so we have discussed 2 heads out of 5 and one more is pending, and we have also discussed income from house property. Sorry, we have discussed 3 heads as such. So as I mentioned, that this is a residual section or residual section, or you can say residual head of income. So what does that precisely mean? So basically it means that if any income is not chargeable under first 4 heads of income, it will be chargeable under the head income from other sources. So section 56 is the basis of charge. Now this basis of charge plays a very important role in determining whether a particular income is chargeable under which head of income. So particularly for income from other sources, the prerequisite is it has to be an income. Now what is income? Again, I'll not go into the basic details. Second is the income should not be exempt from tax, right? And the third prerequisite is it is not covered under any other head of income. So if these 3 prerequisites are fulfilled, then that particular income will be chargeable under this particular head, that is income from other sources. Now, why I'm saying that this basis of charge is very much important, because I'll just slightly go to income from salary, and there we have seen, or you must be aware about the basis of charge, And the one of the prerequisites of income from salary is there has to be employer-employee relationship, right? So if there is no employer-employee relationship, then, or rather, I would phrase it this way, that there is an income, but there is no employer-employee relationship, then that income would be chargeable under that income from other sources. Of course, we'll see some of the examples in the due course. Second head of income is income from house property. Now, in income from house property, the basis of charge says that any income for from a building or land appurtenant thereto is chargeable under the head income from house property. I am giving you a broad view. I am not going into the details of the other heads because those are already covered. Now, when we say a building and land appurtenant thereto, now what does it mean? Appurtenant thereto means, for example, let's say you have a flat and in the same building you have a covered parking. So when you are giving it on the rent, whatever rent that you are charging is for that flat plus that parking facility, which is an kind of add-on facility. But this parking facility is a part and parcel of that flat itself. So this is not a separate piece of land. So it is not an open land or open piece of land that you are having. It is forming part of that building itself. And therefore, the wording says building and land appurtenant thereto, right? But if there is any deviation to this, then it will fall under the residual head, that is income from other sources. Third head of income, income from business and profession. Again, in my presentation, I have covered this in detail, but few of the principles that there has to be a regular and definite source of income, then business should be carried out during the previous year. So all those basic principles or basis of charge we have seen. So again, if any of that principle is not fulfilled, then that income will be chargeable under the head income from other sources. And the fourth head of income, that is capital gain, again the prerequisite is there has to be a capital asset, then there has to be a transfer. So all those cases or all those principles in the next session we are going to see it in detail by our other speaker. I don't want to venture into his area, but the point which I'm trying to explain is uh, if any of the principles or if any of the prerequisites are not fulfilled, then it will be covered or it will be chargeable under the head income from other sources. Right? Going ahead, I will start with some of the examples. Now, you are aware that under section 10, subsection 1, agricultural income in India is exempt from tax. Correct? But what if you have a land outside India and you are getting agricultural income from that land? For example, let's say you have a land in Switzerland, agricultural land in Switzerland, and you are getting an agricultural income. Now, uh, we all are professionals, so I need not explain this, but even a single word can change the entire meaning of that particular section. So, again, just at the cost of repetition, I will repeat that agricultural income in India is exempt. It's not that any agricultural income is exempt in India. It has to be from the Indian land, or it has to be an Indian agricultural land, to put it simply. Right? So again, you can find that this is a residual income and therefore it is chargeable under the head income from other sources. So just to make it again very clear, if it is an agricultural income in India, then it is exempt under section 10(1). But if it is agricultural income outside India, then it is chargeable under the head income from other sources. Now, you will find the reference or relevance of the first three principles that we have seen. There has to be an income. Income should not be exempt. And third one is income should not be chargeable under other head of income. Then income from subletting. Now, again, there will be some like I will be going into the main head and then I'll again come back to income from other sources. So this is just to make you clear about the provision, right? Now, again, if you go to house property, then what is the prerequisite? The assessee must be the owner of that particular property. So let's take an example that A is the owner of that particular property. He has given that property on rent to B. Now, suppose the area of that particular property is 2000 square feet. Out of that, B requires only 1500 square feet. So he is still having 500 square feet extra area with him. And he decides that he will in turn give it on rent to C. Right? Now, A is the owner. So whatever income that he will receive from B, that will be obviously chargeable under the head income from house property, because it fulfills all the conditions of house property. That is, there has to be a building or land appurtenant there too, and A or the assessee should be owner of that particular property. Now, coming back to B, what B has done, B has subletted that property to C, and therefore B is not the owner of that particular property. And again, now you will understand and appreciate the relevance of this residual section or residual head. Suppose this residual head would not have been there, what would have been the case? That B will say, see what house property says, the assessee should be the owner of that property. I am not the owner, and therefore whatever income that I am receiving is not chargeable to tax. To avoid this, this particular residual head has been introduced, and whatever B will receive from C, it is not letting, it is subletting, and this subletting income is chargeable under the head income from other sources. Now, this is as far as the principle is concerned. Now, what are the effects? See, understand the basic principle, and why I'm elaborating all this is many times, even for our clients, in case we ignore this fact, then again there will be a problem. Now, again, you have studied or you already know income from house property. So, in this case, what happens is if you have got income from house property, the income from house property says whatever rent that you have received or whatever gross annual value of that particular property, from that you get the deduction of municipal taxes paid. Whatever remains, that is called as net asset value, and on this net asset value you get a standard deduction of 30 is taxable. Now, this income from subletting is chargeable under the head income from other sources. So the point is, this is, or whatever standard deduction that you get under house property, that won't be applicable in case of income from other sources. And therefore, whenever a new client approaches to you, or even if you have an existing client, just because he is receiving the rent, that does not mean that that rent will be chargeable under the head house property. So the point which I'm trying to explain is, you will have to go into the details and check whether he is the landlord or whether he is the owner or he is only a tenant, and the rent that he is receiving is from a subletting activity, right? So again, you will have to be very careful. One more thing is, there are many corporates. What they do is they take the property on, or they take the property on, the entire property on rent. Let's take an example of a building. So they take the entire building on rent, and in turn they sublet it to the various people. Now, this is their regular business. So taking the property or buying a property and giving it on rent is their regular business. So obviously this is a residual section. So if it is your regular business, so obviously that income will be chargeable under the head income from business profession, and therefore it won't be chargeable under the head income from other sources.
Sir,
So you'll
excuse
have to
me.
keep.
Sir,
Yes.
excuse me. Sir, you are telling that when a business takes a property and keep on submitting to the other for other persons, it will be coming here. So this is apply if a business takes a property on lease, that will apply also.
No. What I'm trying to say is, suppose it is your regular business to buy a property and give it on rent, or to take a property on lease and in turn sublease that particular property. If it is your regular business, then it will be chargeable under the head income from business profession. But if it
Okay.
is your one-off activity, so for example, the example which I gave, let's say you have got 2,000 square foot of a place. Out of that, say for next 6 months, you don't require that 500 square feet area. And only for say 6 months or 1 year, you are given that property on subletting. Then this is not your regular business. It is only a time being arrangement that you have done. And if it is a time being arrangement, then it will be chargeable under the head income from other sources.
And if it is a regular business, then professional business.
Yes. So again, I'm repeating the same point. This is a residual head. If it is your regular business, then it will be chargeable under the head business and profession. But if it is a one-off transaction, then it will be, or subletting, if it is not your regular business, then only it will come under the head income from other sources.
Okay.
Is that clear?
Yes, clear.
Yeah.
Thank you.
Next point is interest on bank deposits and loans. So again, nothing much to discuss, but there are a couple of points which I would like to explain it in detail. Bank deposits, like your fixed deposit, recurring deposit, or let's say the postal MIS and all that. But again, as I said, the income, there has to be an income. Income should not be exempt, and it should not be chargeable under any other head. Now, if it is your interest income from any bank deposit, then it will be chargeable under the head income from other sources. Now, in some cases, what the businessman does is he invests his accruals, business accruals, in, he does some investment in say bank, and whatever income that he receives, that he reports as a business income, because these accruals are from business only, right? And this calls for certain you can say there are many case laws on this matter, that whether it is a business income or whether it is a income from other sources. So the point which I'm trying to make is, if it is business income, or if that interest income is shown as business income, then obviously it will be chargeable under the head PGBP, that is profits and gains from business profession. But other than that, it will be chargeable under the head income from other sources.
No,
Now,
excuse me. So this is not getting clear. That means there is a differentiation, an individual versus businessman.
no,
Yes.
no, no. I'll request all audience that let me complete that point first, and then you can ask the questions. Otherwise,
Okay.
that flow gets disturbed. Let me explain the point in entirely, and then you can ask the question. Yeah. So point number one is, let's say there is a company, and company has done certain investment out of its internal accruals, and secondly, the company has done the investment which is a purely an investment. So in this case, the differentiation is not the individual versus businessman. The crux is, or the basis of charge is, what is the source or what is the intention of that particular investment, and accordingly it will be chargeable. Coming back to individual case, whatever interest that he receives from fixed deposits, recurring deposits, that is obviously chargeable to tax. Now, there are 2-3 aspects which I would like to highlight in this particular matter. Number one, the method of accounting. Like we have method of accounting in business, we also have method of accounting in income from other sources. Now, typically, what the uh, consultant, and even for that matter assessee, makes a mistake. Suppose I have a fixed deposit, and on that, on a monthly basis, I am getting an interest. If I am getting the interest, I will account it for. But if that income or if that interest is getting accrued, the common mistake that many people do is they offer that income at the time of maturity. So let's say I have got a fixed deposit of 10 lakh rupees, and let's say, just for the sake of it, let's assume that the rate of interest is 10% and the tenure of that particular fixed deposit is 5 years. So at the end of fifth year, I'll be getting 5 lakh rupees, right? So what people do is they accumulate this income and they charge it in the year of receipt. But obviously, what will happen in that year of receipt, this entire 5 lakh will become taxable. Instead of that, it should be on an accrual basis. So on a yearly basis, you should offer this to the income so that the overall tax burden will be minimized. Point number one. Point number two is, as you are aware that uh, whenever you are keeping any deposit in the bank, if the income from the securities or income from this particular fixed deposits, recurring deposits exceeds 10,000, then bank will deduct the TDS. Now, many times, whatever calculation bank does and whatever calculation you will do, there will be a slight difference in the interest, right? Because bank has a slightly different method of calculating the interest. So in that case, it is always advisable that you go by the bank. And in that case, rather than doing the interest calculation on your own, you should always take interest certificate from the bank, and basis that only you should offer that income. Now, whether the TDS is deducted or not, you should go by the bank interest certificate, and accordingly, you should offer the income. Third important point is, whenever this kind of fixed deposit interest is there, there will be always some broken period in the sense, suppose I made a deposit on 1st January. So in the last year of the maturity, I'll be getting 9 months of interest only. So all this accounting, particularly for those who are having fixed deposit in multiple banks, multiple branch, this accounting will have to be done properly. Otherwise, there are many incidences wherein people have received the notices. Next, one more aspect is about Form 15G and 15H. Now, even we by mistake do this, or we suggest to the client. Now, let's first understand what is this 15G and 15H. 15G and 15H, yeah, as you are aware, that it's a declaration that my income is below taxable limit and therefore don't deduct my TDS. Now, many people do it as a ritual in the sense without understanding the implications of this 15G and 15H. Now, when I say ritual, what they feel is every year in the month of say March or April, it is mandatory for them to give this 15H and 15G as it may be applicable. It is for one is for non-senior citizen and one is for senior citizen. So as a ritual, they give this form to the bank without understanding the implications. And there are many cases wherein the assessee is having income of say 10 lakh rupees, and still he is giving that 15G and 15H form as may be applicable to the bank, which is a misleading or which is an incorrect declaration to the bank. And there are cases wherein assessee has been issued a notice for the false declaration, because the entire purpose of the TDS provision gets defeated because of this. And therefore, apart from the taxation aspect, you should also guide your client that whenever they are filling up this 15G or 15H form, they should be very careful, and unless and until they really have the income below taxable limit, and when I say below taxable limit, whatever slab is applicable, if they are senior citizens, then the slab applicable for senior citizen, and for non-senior citizen, the normal tax slab, right? So below taxable limit, then then only they should fill up this form 15G and 15H form. Now, from the current year, that is from the financial year 23-24, the overall limit has been increased to 7 lakhs. Now, this is again a debatable issue, or I would say confusion issue, that when I say below taxable limit, so whether it is 2.5 lakhs, or now in the latest budget, they have proposed that up to 7 lakh rupees, you don't have to pay any tax because you get a rebate. So just to clarify, for financial year 23-24, if your income is below 7 lakh rupees, then you can give form 15H and 15G. For last financial year, that is 22-23, the threshold limit was 5 lakh rupees. So if your income is below 5 lakh rupees, then only you are eligible to give this form 15G and 15H. So the point which I'm trying to explain is the accounting for interest has to be done very carefully. And the last point, as far as this interest on deposits is, I had mentioned it in my earlier presentation also, and I'll be explaining in the taxation of individuals again. But since we are on this topic, I would again like to touch upon the concept of annual information statement, AIS, or taxpayer information statement, that is TIS. So in this AIS, so whenever you are filing your return, there are many SSEs who have done investment in certain banks, and somehow whenever they are submitting the record to you, they simply forget to give the information of those interest. And till last 2 years, or till last couple of years, in case the tax is deducted on those investment, then only you will come to know that that particular SSE is having the income from that particular fixed deposit. But if there is no TDS, no way you can cross check whether he is having the income other than what he has already submitted to you. So again, in this AIS, whether the TDS is deducted or not deducted, this will get reflected, and therefore, while filing the return, you should also cross check that whatever interest certificates or whatever interest calculation that your client has submitted, whether it ties up with the AIS or not, or whatever investment or whatever interest which is getting reflected in AIS, whether all is reported in the income tax return or not. Right? Yes. Now you can ask any questions if you have.
The TIS portion again.
Sorry?
TIS portion, can you please repeat again, sir? TIS.
See, TIS is a, I would say, a breach statement. So under each head, they will, I'll explain it in detail when we'll go to the taxation of individuals. But the point is, before filing of return, particularly for income from other sources, before filing the return, you should cross-check the annual information statement of that particular SSE, or even if you are filing your own return, then before filing the return, you should check the annual information statement, because even say saving bank interest. So even in our case, there are few clients who will say that I have got my account in XYZ bank, but there are no transactions, and simply he will not report any income. But when this AIS was introduced, we found that there was some saving bank interest in that bank also. And as you are aware that the saving bank interest, there is an overall limit for the exemption also. So if we keep on adding even the saving bank interest, it should not happen that it will cross that threshold limit. So just for time being, just keep this in mind that before filing your own return or before filing any of your client's return, just make sure that the AIS statement is checked, and whatever income that you are reporting as income from other sources, or for that matter other heads also, it ties up with that AIS. I will have a detailed discussion about AIS and TIS once we'll have the next session, that is income taxation of individuals, which is scheduled on 11th of March. So for time being, let's restrict the discussion to this. If you have any doubts as far as interest is concerned, I'll take up that.
Okay.
Right. And interest on securities issued by a foreign government, these are also chargeable under the head income from other sources. Income from royalty, again, if it is from business and profession, obviously it will go to that respective head. For example, I'll give a small example. Suppose I am a book author and publishing book is my regular business. So in that case, whatever royalty I get from those books, that will be my business income. But suppose out of, say, my passion about writing, I have written a book, a single book, and for that I am getting a royalty. So that royalty will be chargeable under the head income from other sources, because it is not my regular business. This is my one-off activity, right? So that is income from royalty. Then salaries payable to members of parliament. Now again, all these MLAs, MPs, whatever salary that they get, that is chargeable under the head income from other sources. Now, why it is chargeable under the head income from other sources? Because they are elected representatives, and therefore the employer-employee relationship is not there. And therefore, though it is called as salary, it is not chargeable under the head income from salary, but it is chargeable under the head income from other sources. Right? Similarly, whatever fees that you pay to the directors. Now, again, even if it is a particular director is an executive director or non-executive director, whatever director fees that you pay, that is chargeable under the head income from other sources. For example, few companies pay sitting fees to the directors. So that sitting fees will be chargeable under the head income from other sources. Now, just keep this in mind that even if he is an executive director, executive means full-time director, and you are paying him a salary. So that salary part will be chargeable under the head income from salary, because it is out of the employer-employee relationship. But when you are paying him a director fees or director sitting fees, that employer-employee relationship is not there. You are not paying him the sitting fees because he is your employee. You are paying him because he is director of your company, right? Similarly, in many cases, the director will give personal guarantee to the financial institutions, and for that you pay him guarantee commission. Okay, so even this guarantee commission, now being a director, it is not mandatory on him that he should give the guarantee. So he is giving the guarantee out of his scope as an employee of that particular company, and therefore this commission or guarantee commission is also chargeable under the head income from other sources. Similarly, there are directors who will give the underwriting of shares, and for that underwriting of shares, if you pay any commission, then that will be chargeable under the head income from other sources. One more point, if the gratuity is paid to a non-executive director, that means he is not your regular employee. So he is not your whole-time director or executive director. But still, because of his, say, contribution for the company, you want to pay him gratuity on a voluntary basis. Then in that case, it will be chargeable under their income from other sources. Now, again, understand the implications. If he gets gratuity, I hope everybody is aware that there is a calculation of gratuity exemption, right? So that gratuity exemption calculation won't be applicable over here because this is not chargeable under the head salary. So that gratuity exemption will be received only if that gratuity is received by an executive director or your regular employees. If gratuity is paid to a non-executive director, then in that case, it will be fully chargeable. There won't be any exemption which will be there. Similarly, if there is a teacher and who receives any examination fees from a person other than his employer. That means, suppose there is a teacher who is working in a college, and university ask him or her to come as an examiner, and for that the university pays him or her the examination fees, or let's say paper checking fees. So university and that person is not having any employer-employee relationship. That college and that professor is having employer-employee relationship. So whatever college pays him, whether it is salary, whether it is examination fees, whether it is paper checking fees, that will be chargeable under the head salary. But whatever university will pay to him, that will be chargeable under the head income from other sources. Right? Then ground rent. Now, what is ground rent? Suppose there are many cases wherein the land is still in the name of the landlord, and then if the building is constructed, that society or that plot owners, or sorry, flat owners are supposed to pay monthly rent to this landlord. Nowadays, this is not a very common thing, but whatever ground rent that you are receiving, that is chargeable under the income from other sources. Now, please understand again the difference. As I mentioned in the house property, that what is chargeable under that house property? Building and land appurtenant thereto. Now, in this case, even if there is a building, the rent that he is receiving is not for that building. It is for that plot of land. And therefore, this is chargeable under that income from other sources. Similarly, if you have got an open plot of land and if you are receiving any rent out of it, again, the prerequisite is, suppose you have got a land bank and all these lands are given for, say, as a parking area, which is regularly your business, then obviously that income is chargeable under that business and profession. So if you have got a multiple lands and you are giving that property or giving that piece of land on a rent is your regular business activity, then it will not be chargeable under the income from other sources. But let's say you have got one of plot and that you are giving it on rent, then that rent from plot will be chargeable under the income from other sources. Similarly, insurance. Now again, if you are doing this insurance business on full-time basis or substantial part of it, then it is your business income. But if you are doing this insurance commission, so let's say you are working somewhere or you are doing a business and as an additional income you are doing this insurance business also, then it will be chargeable under the head income from other sources. Now, one common question which can come is whether it is beneficial to show as business income or other sources. Again, it depends on case to case basis. So what is regular and what is not regular has to be decided by the assessee with the given conditions.
Sir, can I ask a question, sir?
Yeah, let me just complete this slide.
Okay, right.
There is a last point and then you can ask the question. And last one is mining rent or royalties. Again, if it is not your regular business activity, then this will be chargeable under that income from other sources. Otherwise, it will be your business income. Yes, please go ahead.
Sir, my question is that in an examination fee or paper checking fee, suppose sometimes we used to get fees from the institute for checking the papers or taking lectures. Does it come in the other sources?
Whether institute is your employer?
No.
So that's it. That is your answer.
Okay.
So again, I'm emphasizing on the basis of charge, and under salary, the basis of charge says in order to charge a particular income under the head income from salary, what are the prerequisites? There has to be an employer-employee relationship. Okay. So if you are taking, or let's say if you are doing some supervision for our exams, institute exams, whatever remuneration that you are getting, whether that is your income, the answer is yes. Whether it is chargeable under okay, so whether it is your income, the answer is yes. Whether it is exempt, the answer is no. Whether it is chargeable under some different head of income, the answer is no, and therefore it will be chargeable under that income from other sources. Now, let's take an example that even if you are taking some lectures at our institute, but again, that income is not your salary income, because though you are paid on say hourly basis or on the basis of sessions and all that, institute has not appointed you as an employee. So I hope the distinction is very clear. So whatever institute's employees are getting, that will be their salary, but whatever you are getting, that will be your income from other sources. Now let's take an example that on a full-time basis, you are taking lectures at institute, plus you are doing some supervision work, plus you are also checking papers, and you practically are not doing anything else. Then you can treat this as your business income also. So again, the deciding factor is whether it is your regular income or this is your one-off income. Or the second criteria could be whether it is your main income or you can say subsidiary income, or that way you can decide. Is that clear?
Yeah, clear.
Yeah, the first point is actually a repetition. Annuity payable under a will. Now, many times, whenever a will is made, many times, suppose, for example, let's say if I donate a property to some NGO and I keep a rider or I put a condition in that will that every month you will pay, say, 20,000 rupees to my son as an kind of annuity. Okay. Now, the point is, it is mentioned in the will of my, say, father, and who is paying me? That NGO is paying me that annuity on a monthly basis. Now, whether that annuity which I am receiving from NGO, that whether that NGO is my employer, the answer is no, right? And therefore, again, the principle says, if it is not chargeable under first four heads of income, then it will be chargeable under the last head or residual head, that is income from other sources. Sorry, it is in continuation. Will, contract or trust deed, then it is chargeable under the head income from other sources. Now, the next point is family pension received by family members of a deceased employee. Now, again, there is a difference between is received by that employee. Now, again, I'll touch upon the concept in salary. Now, what is chargeable under the salary? As I said, there has to be an employer-employee relationship, but that employer-employee relationship can be in the past, present, or future. So, take an example of pension. That pension is received because of your employment in past. So, after your retirement, typically you get the pension. Now, even if you are getting it from your former employer, still it is considered as your salary income. Correct? But take a case that suppose that employee dies and his family members are now getting the family pension. Typical example is, let's say, army personnel. Suppose unfortunately he dies in a war, or he dies and his family members are getting any pension. So in that case, that family member, suppose his wife is getting that pension now. Now, please understand that his wife and that company does not have any employer-employee relationship, and that wife and that company even does not have that employer-employeeship in the past also, and therefore, whatever family pension is received, that is chargeable under that income from other sources and not a salary income. One more point is, in case of retirement, interest on employees' contribution if provident fund is unrecognized. Now, I hope you are aware about two kinds of provident funds. One is recognized and other one is unrecognized. If you have got your own provident fund trust, and if it is not recognized by income tax department, then it is typically called as unrecognized provident fund. Of course, this concept is very rare nowadays, because in old days, when PF department, as you are aware that it was a complete mess when it was offline. So big companies like Tata's, Birlas and all that, they used to have their own trust. They used to get the recognition from the income tax department, and they used to pay provident fund and whatever pension and all that from their own fund. But nowadays, because of this provident fund has become online and all that, now many companies are directly with PF department rather than having their own trust and all that. So let's forget about that part. Our point of discussion is, if it is recognized provident fund, then whatever interest that you get from provident fund is exempt, as you are aware. But if it is unrecognized provident fund, I will repeat once again, unrecognized provident fund means if your trust, provident fund trust, has not received recognition from the income tax department, that is treated as unrecognized provident fund. Then in that case, interest that is received from by an employee on the provident fund, that is taxable under the head or chargeable under the head income from other sources. Next point is again very important, income from undisclosed sources. Now, just imagine a case that there is a raid by income tax department, and let's say few crore rupees, let's say 15 crore rupees unaccounted is found at that particular person's house. Now, under which head you should account it for? Practically, you cannot really bifurcate that, whether it is from salary, whether it is from business, whether it is from capital gain and all that. So it's a combination of all, and therefore whatever undisclosed income is received, that is chargeable under the head income from other sources. Income from racing establishment, nothing much to explain. Casual income. Now again, I have mentioned this earlier also, that if you have got a casual income, then it is chargeable under the head income from other sources. A classic example, which so we have done cracker business during, say, Diwali season, right? So this is one-off activity that we have done it in the year. So it is not your regular business. So one-off business is to sell crackers during Diwali, right? Or maybe to do some seasonal business. For example, in Maharashtra we have this mango season. So there are people who do this mango business during this mango season. Typically now this April, May, June, 3 months I will be doing this mango season. Now please note that I am not a farmer. Farmer selling a mango, it is treated as an agricultural income. But if I am trading in mango, then that will be my income from business. But this is my casual income, and therefore this is chargeable under that income from other sources. Any compensation received for use of business asset, again, if it is not your business activity, then it will be chargeable under that income from other sources. Annuity payable to lender of a trademark, again, if you are holding a trademark, but if it is not your regular business, then it will be chargeable under the head income from other sources. Next one is interest on compensation on or enhanced compensation. Now this is typically a capital gain case. Now just take an example that suppose there is an asset which is compulsorily acquired by the government. As you are aware that for public utility projects like, say, for example, highways, railways, metros and all that, state government as well as central government has a right to compulsorily acquire the assets. So let's say there is a compulsory acquisition of your asset and you have received a compensation, or let's say the asset is compulsorily acquired and as per the agreement you are supposed to receive the compensation within 1 month. But let's say there is a delay and you have received the compensation after, say, 1 year. And the agreement says that if there is a delay in paying the compensation, you are liable to receive the interest. So along with the compensation, you have also received the interest. Now, whatever compensation that you have received, that is chargeable under that income from capital gain. So there is a typical calculation which we'll get to know tomorrow. But tomorrow in the sense the next session on capital gain. But whatever interest on that enhanced compensation that you will receive, that will be chargeable under that income from other sources. Second case is you have received the compensation, but you are not satisfied with the amount of compensation, and you have applied in a high court for enhanced compensation. But whatever interest that you receive on that enhanced compensation is chargeable under that income from other sources. Rental income from plant, machinery, and furniture. Again, there is a concept called as composite rent. So let's say you have given a flat on rent, and there is a composite rent. That means whenever you are giving that property on rent, you are saying that this is my furnished flat, and for that I will charge say 50,000 rupees per month, right? So in this case, this is called as composite rent, wherein you don't have any, or that tenant don't have any option that whether he wants that furniture or no. Whatever as is basis you want to give that flat on rent, and for that rent received is 50,000 rupees. So in this case, that 50,000 rupees rent which is charged, which is received, that is your house property rent. But let's say you have given a choice that this is my flat, the rent for this is say 30,000 rupees. Now I have got a TV, and if you want to have that, or if you want to return that, the rent will be say 1,000 rupees. I got this say washing machine, or say whatever white goods like say microwave, fridge, and all that. So all put together, let's say my rent will be 10,000 rupees. So 30,000 rupees is for the flat, and 10,000 is for the plant and machinery, furniture that I am having. So if these two things are separable, then whatever 30,000 rupees the rent that he is receiving for the building as such, that is chargeable under the head income from house property. However, whatever income that he receives from plant and machinery or furniture, that is chargeable under the head income from other sources. Again, the principle is same. If it is your one-off activity, then it will be other sources. If it is your regular business to give the plant and machinery and furniture on the rent, then in that case, it will be your business income. So that basic principles remains the same. One more point is advance money forfeited. Now, there was an anomaly in this case. The anomaly was, before that I will just explain this concept. Suppose you want to sell a property. Now selling a property is a process. It's not that today morning you decide and by today afternoon you will sell the property. It won't happen like that. So let's say whenever you want to sell a property, the first thing that you typically do is you float an advertisement. Then there will be a potential buyer who will approach to you, and he will give you a token amount, or in income tax language it is advance money. Now what he's supposed to do, so you enter into an agreement that after receiving the token amount, within 1 month you are supposed to enter into an agreement, otherwise that token amount will be forfeited. Now he has given you 1 lakh rupees, and within 1 month he is supposed to enter into an agreement, and he is supposed to pay the balance amount, but he has not turned up, and this 1 lakh rupees that you have received as an advance or token amount, you have forfeited. Now the earlier provision was this 1 lakh rupees used to get deducted from the cost of acquisition. That was earlier provision. Now what was the anomaly in this? Suppose I have purchased a property 15 years back for say 5 lakh rupees. Okay, and today I am receiving the advance money, and that advance money forfeited is 1 lakh rupees. So the earlier provision was this 1 lakh rupees used to get deducted from that 5 lakh rupees. But what was the anomaly? The anomaly was this 5 lakh rupees was 15 years back, and 1 lakh rupees I have received today. So obviously I cannot, these two figures are not comparable on apple to apple basis, because obviously because of the time value of money. And therefore there were representations made, and later on they amended the section, and now if the advance money is received and if it is forfeited, then it is income from other sources. Compensation on termination of employment or modification of terms of employment. Again, this is chargeable under that income from other sources. And the last point is family pension. 1/3 or 15,000, whichever is lower, is exempt. In this budget, there is an amendment to this. The amendment is, even if you are opting for a new regime, old regime and new regime, again, once we'll go to the individual taxation session, I will explain you it in detail. But just for time being, just keep this in mind that for the current year, that is financial year 22-23, that is AY 23-24, if you are opting for new regime, then you are not allowed to take standard deduction, and even this 1/3 or 15,000, whichever is lower, family pension deduction. But from 23-24 onwards, even if you are opting for new regime, still you will be able to claim the standard deduction as well as this 1/3 or 15,000, whichever lower, as the exemption. Yes. Any doubt so far?
Sir,
Yes.
can I ask?
Advance money
Yes, please.
forfeited, sir. Advance money forfeited portion, sir.
Sorry?
Advance money forfeited. Can you please repeat it? It could not be understood.
See, advance money forfeited is whenever you are selling a property, and for that your potential buyer has paid you an advance or say token amount. Now, whenever that token amount is received, what he is supposed to do is, so you enter into a basic agreement that once this token amount is received, within 1 month you will enter into an agreement and you will pay the balance amount. Now, the potential buyer has not fulfilled his part of the contract. So you have forfeited that money. So this forfeited money is chargeable under the head income from other sources. Is that clear, or you still have some doubts?
No, sir, you're taking some case laws you're mentioning this, but anything?
Sorry?
Any case laws are there? You're mentioning something case laws. Some case laws you're taking about, sir?
For this advance money forfeited?
Just now you mentioned some case laws, no?
No, not case law. Earlier the provision was, if the advance money is forfeited, you were supposed to deduct it from your cost of acquisition.
Okay.
Now they have amended the section, and this is not a recent amendment. A couple of years have been there. So now what they have stated is, this income, that is, if you forfeit the advance, then that is treated as your income from other sources.
Okay.
So I was talking about the amendment, not the case law.
Okay. And annuity payable under will, what is that thing, sir?
See, basically, suppose you are giving any property on a will, under a will to, for example, say to some NGO or say any trust, and in that you have mentioned that I am giving you, say, this flat on flat as a part of the will, but in that you have mentioned a condition that you will have to pay 20,000 rupees per month to my son after my death. So the property is in the name of that trust, but there is a condition in that will that this property will become your property provided you pay 20,000 rupees per month to my son. Then whatever that son receives as an annuity, that is chargeable under that income from other sources.
Okay. Thank you.
So this is just an example. The conditions can be like the way you draft, but just to clarify what is annuity, this was just an example.
Okay.
Yeah,
Any
just
other doubts?
one question. Yeah, one question.
Yes.
This family pension is pension received from EPFO, isn't it?
Sorry, from?
Family pension is received from employees provident fund organization. This is what my understanding is.
Correct. So basically, again, once we'll go to the individual taxation, I will explain it in detail. But for time being, just keep this in mind that whatever family pension is received by the family members of the employee, 1/3 or
Yes.
15,000, whichever is lower, is exempt. I'll come to
Okay.
that in detail in the next session. Otherwise, practically nothing will be left over for the next session.
Yeah, but there is a pension coming from privately taken insurance policies or policies from insurance companies.
No,
So
if
that
you are
also
taking a
should
private,
Uh,
no, see, basically that is not your family pension.
I know that's why.
So basically, if you are taken a policy, life insurance policy, so
Not life insurance, pension policy.
so basically whatever family pension that you receive, that is exempt to the extent of 1/3 or 15,000, whichever is lower. So whether it is from government, whether it is from non-government, or whether it is through your policy.
So it covers that.
Yes.
Okay. Okay.
Any
Thank
other?
you.
Yeah. Any other doubts? Otherwise, we'll move to the next slide. Okay. So the next point is dividends. So again, dividends are chargeable under the head income from other sources. The exception to this is if the dividend is received from a cooperative bank or foreign companies, it is exempt. So in short, if it is received from a domestic company, it is chargeable to tax. Now in dividend, there has been quite a few amendments, and the main, I would say, area of amendment is in whose hands this dividend will be taxable, right? So earlier provision was it will be taxable in the hands of shareholders or the recipient. Then they amended the section stating that the company who is paying the dividend, the company is supposed to pay the dividend distribution tax, and it will be exempt in the hands of the shareholders, right? So there was a concept called as dividend distribution tax. Now there was a resistance from many companies or many corporates because please understand the sequence. On the tax, you first have to pay the income tax. So let's say my profit is 1 crore rupees, and on that I'm supposed to pay say 25%. I'm just taking some hypothetical rates. So let's say I'm supposed to pay 25% as the corporate tax rate. So I'm supposed to pay on 1 crore rupees, I'm supposed to pay 25 lakh rupees as the income tax. Balance remains as 75 lakhs. Now from this 75 lakhs, let's say I'll be declaring the dividend, right? And on that dividend also, I was supposed to pay the dividend distribution tax. So from a financial management point of view, this dividend was a very costly affair for the companies. Okay. And therefore, there were many representations made by the corporates. And now, again, they restored the original or earlier provision, I would say, that dividend distributed by a company is chargeable under in the hands of the shareholders. Now, as you are aware that corporates will have a lot of pressure on the government, and even the government at times will have to bend and they will have to change the law. But if you really look at from the income tax point of view or from the revenue collection point of view, having dividend distribution tax is from according to me is much easier for the income tax department to collect the revenue, because when it is distributed, let's take an example of say Reliance only. Now Reliance, if they distribute say 100 crores rupees of dividend, to get dividend distribution tax is a one stroke point. So of course they cannot hide anything. On 100 crores they will have to pay the dividend distribution tax. Now when this 100 crores of say I'm just taking some hypothetical figures, I don't go by the figures as such. Now when this 100 crore dividend is distributed between say 1 crore uh, shareholders of Reliance, then to collect the tax from this 1 crore individual is a bit administrative work. But as I said, because of the pressure from the corporates, even the government will have to change or amend the section at times. Okay, let's not go into that. So basically, the point of discussion is whatever dividend that you receive, that is chargeable under the head income from other sources. Now, yeah, so there is one more concept called as deemed dividend, which we'll be discussing slightly later. And why we will be discussing slightly later, that also I will explain. But just keep this in mind that we have not yet finished the dividend topic. I'll come back to you in some time after we go through some of the other sections, and I'll come back to you on this dividend once again. The next is winnings from lotteries, crossword puzzles, races, gambling, betting of any form. The tax rate is 30%. Now, as you are aware that the name of the act is Income Tax Act 1961. So what is chargeable normally is income. I'll repeat my sentence. What is normally chargeable is income. But here, the wording used is winnings. So what does that mean? Suppose I purchase a lottery ticket and let's say the winning amount is 10 lakh rupees. But prior to this, let's say I have spent 2 lakh rupees on the lottery and the winning amount is 0. So if I use the word income, what is my income? 10 lakhs minus 2 lakh rupees, which I have already spent on buying a lottery ticket. But here the wording is lottery winnings and not lottery income. So I will have to pay 10 lakh, 30% on this 10 lakh rupees. Now, again, there is an amendment in this current budget. I really failed to understand why this is amended. And now they have restored that, or now they have changed the wording from winnings to net income. So now onwards, and again, this is current year budget proposal. It is not yet finalized, but assuming that the same budget will get finalized from the year 23-24, the lottery income will be chargeable on income basis and not on winnings basis. I really don't find any logic in amending this section, because this is totally a casual income, or this is totally a kind of gambling income. Similarly, if it is purely a gambling, for example, even your Kaun Banega Crorepati, it is purely a gambling. Why? Because there are 4 options. Have any knowledge, and by chance, if you press a button and that happens to be a correct answer, you will get the money. So whatever money that you get from Kaun Banega Crorepati, even that is chargeable at 30%. So whatever income that you receive in the bank, that is after deducting the TDS of 30%. So you'll have to gross it up. So let's say if you have received 70 lakh rupees in your bank account, 70 lakhs is not taxable. You'll have to gross up that amount to 1 crore rupees, and 1 crore is chargeable to tax. Is that clear?
I think this net income has come in this budget for the online gaming.
Correct, but the point is, whatever you spend, you get it as a deduction.
No, I think it is for setting of loss. You may gain somewhere, you may lose in some games. So the net is chargeable.
But what is loss then? See, basically, if I purchase a lottery ticket and there are no winnings, so it is kind of loss to me.
Okay.
So that is what is the point, that for this particular income, the correct wording was winnings from lotteries, crossword puzzles, because it is purely a gambling. So giving any concession to a gambler, I don't think is advisable to any economy. Anyways, that is finance minister's call. But at least I don't see any merit in amending this particular part. Anyways, so let's not go into what is wrong and what is correct. But just for your information, this has been a change. Otherwise, there are very few sections, or there are very few provisions wherein the wording is not income, but rather the wording is the wording is income. Very few cases the wording is other than income. This is one of those provisions wherein instead of using the word income, the word used is winnings. So again, you'll have to be very careful while dealing with this. Any sum received under key man insurance policy, again, like whatever key personals are there in your organization, if you take a insurance policy and if you get a compensation against that, then it is chargeable to tax. Any gift exceeding 50,000 rupees in aggregate received from non-relative. Okay, now each and every word is important. 50,000 rupees in aggregate. So what does that mean? If I get 10,000 rupees 6 times, then it becomes 60,000 rupees in aggregate. So anything above 50,000 rupees is chargeable to tax. So that is up to 50,000 it will be exempt. Over and above 50,000, whatever I get from a non-related person is chargeable to tax. Right? Now, I hope everybody is aware about the definition of related party. But just to clarify, it includes all your lenient ascendant and lenient descendant. That means if X is an assessee, then his father, mother, then his grandfather, grandmother from paternal as well as maternal side will be included, and all those above will be considered as related party. Similarly, then son, daughter, and let's say your real brother, real sister will be considered as your related party. So again, you'll have to be very clear about this definition of related party as to what is included and what is not included in the definition of related party. And if it is, if the gift is received from a non-related party, then only it is chargeable to tax. Otherwise, it is exempt. So let's say son is getting gift from the father. There is no limit practically. Whatever gift that he receives, that is completely exempt from tax. Right. So again, you'll have to be very careful about the definition of related party and non-related party. Right. Then section 2, subsection 22, subsection clause E, that is deemed dividend. Yes. Now, what is this deemed dividend, and according to me, why it has lost its importance to some extent, I would say. See, as I mentioned just few minutes back, that corporates used to, okay, just before that, as far as that gift is concerned, there is a big flaw in that provision. And what is that flaw? Whatever you receive at the time of ceremonial occasions is exempt from tax. So let's say whatever you receive at the time of your marriage as a gift, that is exempt from tax at the hands of recipient. So now you'll realize that all these fat weddings which are happening and lot of gifts are getting exchanged, and that in a way it's a kind of converting your black money into white, or let's say converting that money. So the point is, whatever you are receiving at the time of your marriage, that is not chargeable in your hand. But at the same time, you should keep in mind that the person giving that gift. So just recently, you must have read in the newspaper that I think KL Rahul and Shetty, Sunil Shetty's daughter, they got married, and Sunil Shetty himself has given, say, 50 crore of flat. So of course he is a father, so he can always give that 50 crore flat to his daughter. So nothing will be chargeable. But apart from that, there are many celebrities who have given, say, some of the celebrity, I don't remember the names and all that, but some of them have given a car of 1 crore rupees. Some of them have given diamond set and all that. So, of course, all these gifts which are received at the time of ceremonial occasions are exempt from tax. But suppose these gifts are given, and suppose income tax department issues the notice to whom, by whom this gift has been given, so he will have to prove the source of his income. Right? Are you getting the point? The person who is giving the gift, suppose there is a notice issued to him by the income tax department, he will have to prove the source of this money. But if the gift is received by the or by a person at the time of ceremonial occasions, then it is exempt from tax. So unfortunately, this is used as a tax planning tool, but it is, to my mind, it is tax avoidance rather than tax planning. Anyways, let's not go into that debate. Right. So coming back to deemed dividend, the deemed dividend under section 2, subsection 22, clause E. Now, again, let's talk about some background. And just few minutes back, I have explained that earlier it was the dividend which was paid by the government, sorry, not government, the dividend which was paid by the companies were required to pay dividend distribution tax. Now, to avoid this, what they started doing was they started giving the dividend in some other form to the shareholders. Okay, what are these other means, which I'll be explaining. So, in short, just to avoid the payment of dividend distribution tax, they were not giving it a tag of dividend, but they were paying it to the shareholder in some other form, and therefore this particular concept of deemed dividend has been introduced, and even this deemed dividend is taxable in the hands of the company, and company will have to pay the dividend distribution tax. But now, since the dividend is taxable in the hands of shareholders, this particular provision has lost its importance. I'm not saying the provision has lost the importance, but because it is chargeable in the hands of shareholders, now company is no longer encouraging this kind of deemed dividend cases. Right. So let's understand what is this deemed dividend. Any distribution entailing the release of company's assets. So let's say instead of giving the dividend, if mine is a, say, computer manufacturing company, so I distribute, say, laptops to my shareholders. So when I'm distributing laptops, it is obviously I'm releasing it from my stock, and stock is nothing but my asset. So any distribution which is having impact or which is releasing your company's assets will be treated as the dividend. Similarly, any distribution of debentures, debenture stock, deposit certificates, and bonus to preference shareholders, this is also treated as deemed dividend. So let's say if I want to pay, say, 1 lakh rupees as the dividend, so rather than paying 1 lakh rupees as the dividend, I distribute debentures of worth 1 lakh rupees to the shareholder. So if you really look at it, it is not tagged as dividend, but it will fall under the definition of deemed dividend under section 222E. Similarly, distribution on liquidation of a company, distribution on reduction of capital, all this will fall under the definition of deemed dividend. But of course, there could be certain genuine cases also, so which also we will discuss quickly. So any payment by way of loan or advance by a closely held company to a shareholder holding substantial interest, provided the loan should not have been made in the ordinary course of business, and money lending should not be a substantial part of company's business. So as I said, whenever a new provision or whenever there will be a provision, people will try to find out some way or other to hide that income or hide that payment. Now, what companies or corporates started doing, they used to route this transaction through their closely held company. So let's say A is a company, and rather than giving anything to the shareholders directly, it will be routed through, say, company B, who is a closely held company of A. So B will pay, say, for example, uh, say, provide any loan, or let's say interest-free loan to the shareholders of A. So even this is considered as deemed dividend. Now the only exception in this case is if lending is not your primary business. So let's say HDFC Limited and HDFC Bank. So A is a shareholder of HDFC Bank, and HDFC Limited, who is into housing loan exclusively. So HDFC Limited has given a loan to A, who is a shareholder of HDFC Bank. But this is in the ordinary course of business, because lending money is a business of HDFC also, and therefore it will not fall under the definition of deemed dividend under section 2 subsection 22 clause E. Right? So it should not be a regular business of the SSE. Similarly, when a company in which the public are not substantially interested, that means typically the non-listed companies extends a loan or advance to any of its shareholders who has more than 10% voting power for the individual benefit of such shareholder to the extent the company has accumulated profit. So again, for private companies who are not listed on a stock exchange, extends the loan to a person or to a shareholder who is having more than 10% of the voting power, then also it will fall under the definition of deemed dividend. And finally, like the exception which I already discussed, that if the loan given by a company involved in money lending, where loan have been extended in the ordinary course of business, or loan is extended to shareholders subsequently adjusted against the dividend declared or distributed, then it is not treated as deemed dividend. Just a small example, ABC Private Limited is a company. The public is not substantially interested. Hari is one of company shareholders who holds 15% shares. The company has accumulated profits of 25 lakhs as on 31st March 2018. The company granted a loan of 1 lakh rupees to Hari by way of an account paid check. He repaid the amount on 5th May 2018. In this case, even if the loan has been repaid by Hari, the loan amount granted to the extent of accumulated profits are treated as deemed dividend. That means 1 lakh rupees, which is granted as a loan, even if he has repaid it immediately, that is on 5th May 2018, to the extent of accumulated profit. So let's say since the accumulated profits are 25 lakhs and the amount given is 1 lakh, this 1 lakh will be treated as deemed dividend under section 222E. Okay. Any doubts so far? In this deemed dividend? Okay. So we'll move ahead. The next part is money property received without consideration or inadequate consideration. By mistake, I have written of inadequate consideration. It should be or inadequate consideration. So typically, we have seen that if I get, say, by check or in cash, more than 50,000 rupees from my non-related person, it is chargeable to tax, right? But what if I received an immovable property or movable property without any consideration or without adequate consideration? Now, what happens to that? So first, let's take a case that I have received an immovable property. Now, if the stamp duty value of this property is less than 50,000 rupees, then nothing is chargeable to tax. Again, please keep this in mind that I'm mainly talking from a perspective of a non-related person. If a property is received from a related person, then obviously nothing is chargeable to tax, right? Just keep this in mind. So condition number one, I have received a property, the stamp duty value of which is less than 50,000 rupees, then nothing is chargeable to tax. But if I receive a property whose stamp duty value is more than 50,000 rupees, then the value which will be considered will be the stamp duty value of that particular property will be considered as the value for this particular transaction. So for example, I have received, say, immovable property. The stamp duty value of that particular property is, say, 10 lakh rupees. So what is chargeable in my hand? 9,50,000 rupees, because the stamp duty value is 10 lakh rupees. Out of that, 50,000 rupees is exempt. Balance 9,50,000 rupees is chargeable to tax as income from other sources. Now, please keep this in mind that you are getting that property as a gift. You are not selling that property. Whenever you will sell that property, there will be a capital gain applicable on that, and that you'll have to pay. That is a separate thing. But what we are discussing about is when you get a property, that we are discussing. Next is you are not getting it free of cost, but you are getting at a concessional rate. So again, the point is, if the stamp duty value is more than 50,000 and the amount which is paid is equal to 5% of the consideration. So let's say again, the stamp duty value is, say, 10 lakh rupees, and 5% of that, that is 50,000 rupees, is, or 50,000 rupees or less is the consideration that you have paid. Then in that case, the entire stamp duty value, as exceeds the consideration, becomes your income under income from other sources. Now, for immovable property, that is land, building, there is always a stamp duty value which is available. But if it is other than immovable property, then for that, the only difference is, instead of stamp duty value, because for movable property, for example, car and other other movable properties, there is no stamp duty value. So instead of stamp duty value, your fair market value of that particular property will be considered. When you buy any property, whether it is movable or immovable, you'll have to see to it that, and of course, either without consideration or at a concessional rate, you'll have to check whether the consideration that you have paid, or if there is no consideration, if it is immovable property, then the stamp duty value, and if it is movable property, then the fair market value of that property will have to be seen. Here, we'll quickly see some case laws which are based on income from other sources, and post that we'll take some questions and answers. Right. So the first case law is this is a Delhi High Court judgment. Business transactions with Holiday Resorts Private Limited. As a result of these business transactions, there were some financial transactions, and because of the shareholding pattern, it would fall under the deemed dividend as per the assessing officer. So the case law is assessee had connection with this Holiday Resorts Private Limited, and he was also a shareholder in that particular company. So whatever payment or whatever financial transaction had happened, the assessing officer was of the view that this falls under section 222E. But the court held that the assessee was involved in booking of resort for the customers of these companies and entered into a normal business transaction as a part of its day-to-day business activities. Such financial transaction cannot be under any circumstances be treated as a loan or advance issued by the assessee for these concerns for the purpose of application of section 222E. So again, the facts of the matter should be checked, and you should check whether it is a normal business transaction or it is falling under the scope of section 222E. Right. The next case is assessee was engaged in the sale of lottery tickets. He won the prize on unsold tickets, where it would be whether it will be a business income or lottery income. So let's say I am a lottery vendor and I have got some unsold tickets with me, and out of that unsold tickets I have won a lottery ticket. So the assessee claimed that this is my business income, but the court held, this is Kerala High Court decision, that even if this is your business, what is your business? Buying and selling a lottery ticket is your business. So from that, whatever commission that you are getting, that is definitely your business income. But from unsold ticket, if you won a lottery ticket, then that will fall under income from other sources, and which is liable for 30% tax rate. Right? Then loan or advance given to a shareholders by the company in return of an advantage conferred on the company by the shareholder be deemed as dividend. So there is some favor which that shareholder has done, and because of that the loan is given to that shareholder. So again, he is not, so basically the point is he has done some kind of favor for the company. Now because of the time constraints and because of this thing, I have not covered the entire facts. But let's say if I'm a shareholder, and for example, let's say I have given some business to the company, and in return the company has given me some loan or advance. Right? Now this is not only because I am a shareholder. So let's say there are two shareholders and one of them has done some favor for the company, and because of that the company has given him the loan. Now two shareholders are not treated at par, and therefore it is held that the advance given to the assessee by the company was not in the nature of gratuitous advance. Instead, it was given to protect the interests of the company, and therefore the said advance cannot be treated as deemed dividend in the hands of the shareholder. Right. So again, the substance of and the facts of the case should be checked, and accordingly you will have to conclude whether it is an income chargeable under the head of other sources or not. And this is very important and very tricky at times to check whether it is your income or not. So maybe till this point, those who are not aware about this section 222E would never have checked whatever loans or advances that a particular assessee gets or in. So you treat it as a normal loan or advance. But again, there is a this angle also attached to it. But as I said, because of the abolition of dividend distribution tax, now this particular practices, which were intentional practices, of course, have been stopped to some extent. And the last case law is lending of money was substantial part of the business of the lending company. The money given by it by way of advance or loan to the assessee could not be regarded as dividend, as it had to be excluded from the definition of dividend by virtue of specific exclusion in section 222. This also we have already discussed, that if it is buying or rather lending, if it is your regular business, then it cannot be treated as your dividend. Right? So this is most of the things that I wanted to discuss. So apart from this, there are few things like there are different financial instruments, like for example, zero coupon bonds or deep discount bonds. So again, what is deep discount bonds? Typically, when you keep a FD, you get a interest on that. But these deep discount bonds are issued at a discount, and at the time of maturity, you get the face value. So again, how to do the accounting for? Of course, this deep discount, whatever that you receive, that is your income from other sources. The issue is how to account it for. And the simple thing is, whatever discount amount is there, that is amortized over the period of that bond, and that becomes your income for that particular year. So let's say 1 lakh rupees of bonds are issued at say 80,000 rupees, and the period is of say 4 years. So 20,000 rupees is the discount that you receive, and 4 years is the tenure. So every year your income will be 5,000 rupees. So whether it is deep discount bonds or zero coupon bonds, so there are many financial instruments which are issued by the companies, and finally whatever income that you get. So it's not necessary that it should be always called as interest only. So like in this case of deep discount bonds, the wording is discount, but still it is chargeable under that income from other sources because of its nature. So instead of putting 100 rupees and getting interest, it is other way around. You get it at a concessional rate, and at the time of maturity, you get the full value. So likewise, you get certain income under the head income from other sources. As far as say the deduction part is concerned, though I have not included in my presentation, basically whatever expenses that you exclusively do for that particular activity. For example, I'll give the example of say renting of plant and machinery and furniture. So in this case, whatever expenditure that you incur for that machinery and plant, so let's say depreciation is there, or let's say repairs and maintenance for that furniture and all that. So those are allowed as deduction. Similarly, if any commission is received, then whatever expenses that you incur exclusively for that particular earning that commission, that is deductible as taxes, deductible. Similarly, we spoke about say compensation or enhanced compensation. So again, just to recap that particular provision, your asset has been compulsorily acquired and there is a delay for getting that interest, or you are not satisfied with the compensation and hence you have gone into the court for the enhanced compensation. Now, whatever expenses that you incur to get this compensation or to get this enhanced compensation, that is also deductible by way of deduction. So to sum up, like whatever expenses that you exclusively do for that particular income, these are allowed as deduction, right? So that's it as far as income from other sources is concerned, and I leave the forum open for any questions or answers. And as I said, I know like there will be few questions, but we'll be having a separate session on individual taxation. So there I would like to cover those aspects, but and that is why I have not touched upon those concepts in entirely, but in the due course, whenever we'll have that session, in that I'll try to cover up those aspects also. Yes, any doubts, any questions?
Yes, one question I have.
Yes.
Yeah, interest from corporate deposits, bonds, and all will come under other income only.
Yes. Any type of interest, like whether it is fixed deposit, recurring deposit, saving bank interest, corporate deposits, debentures, everything will fall under this. Even say dividend on preference shares, dividend on equity shares, everything will fall under income from other sources.
Okay. Thank you.
Yeah. Yes. Anything else?
You can unmute yourself and ask the question.
Or you can put it in the chat box also if you have any issue in directly asking the question. See, the point, like in business profession also, I tried to touch upon some of the practical aspects. So in income from other sources, to me, the main crux is the classification of income. So that is the reason why I spend more time on what is chargeable under this particular head. Because many times it is a kind of no man's land, or maybe if it is not chargeable under first four heads of income, so that is chargeable under this income from other sources. So that is the reason why you should be very careful about the classification of income, and why classification is important. As I mentioned to you, I'll repeat that example once again. Whatever rent that you receive as a owner of that particular property, you get 1/3 of NAV as the deduction. But if it is subletting, then you won't get that deduction as far as that 1/3 portion and all that. So, and that is the reason why the classification of income in the correct head, whatever these 5 heads are there, so classification of income in these heads is very much important. So there are certain exemptions or deductions which are applicable for that particular section only. And if you don't classify it correctly, then again, there could be a notice from the income tax department, and you'll have to pay the differential taxes along with interest and penalty. And that is the reason why you should have the clarity of the subject. And for that, again, the charging section is what is very much important. And you'll have to check that whether it falls or whether it satisfies the charging section of first 4 heads. And if the answer is no, and if that income is not exempt from tax, then it will be chargeable under this particular head. Yes, any more questions? In fact, I thought last 5 to 10 minutes will be for question and answer, so I had scheduled my lecture accordingly.
Yeah, just one question.
Yes.
This last year, that new section 1012, interest accrued on contributions to provident fund above a certain limit, that also comes under income from other sources.
Yes, in fact, this year also they have introduced, there was an amendment that above certain limit, there will be the interest will be chargeable, and it will be subject to TDS provisions also. So yes, whatever is even, let's say, in the normal course of thing, the provident fund interest that you get is exempt from tax. But yes, section 1012, that threshold limit, over and above that, it will be taxable.
Thank you.
Any other question?
I hope there was some value addition from the session, and I tried my level best to clarify the doubts that you had asked. So I hand over the session to Vinayak sir for conclusion.
Thanks. Thank you, Amit. Before I will hand it over to Ashish Bhavsa, I would like to inform you that from Monday we will have a webinar on Excel macros. And series of webinars on Excel macro is going on. It will be on Monday and Wednesday from 7 to 9:30 p.m. On Tuesday, that is 14 February 2023, we are having a full day seminar at Indian Merchant Chamber Churchgate. It is a joint program between WRC and Corporate Law Committee. So I will request you to join for that program also. Now I will hand it over the session to CMA Ashish Bhaug sir.
Thank you, sir. So, as Gulkarni sir has already mentioned, we are going with 2 series, and both the series are going well. And today in our direct taxation income tax series, we have completed our 4th session. And I thank Amit Sahane sir for his valuable input, and I also thank all the participants for taking active participation in the webinar. And as Gulkarni sir has already mentioned, we are inviting all of you to join on next Tuesday about the seminar on corporate law, that is with corporate law committee for inaugurating this month as a corporate law month. So we're looking forward your all active participation, specifically from the Mumbai CMS. And in this our income tax series, next session will be on next Friday. So we once again looking you all for the active participation in this series, as well as in a micro Excel series. And once again, thank you Amit Sahane ji for his valuable input and time. So thank
you, CMA Ashish, and thank you, CMA Vinay Kulkarni sir.
Thank you, CMA
for
Amit.
this opportunity. Yeah, thank you.
Thank
Thank you all
Thanks
participants for your active participation.
And
Hope you to see you all for the next session as well. Thank you.
yes.
Yeah. Thank you.
Good night.
Good night.
Yes.
Okay.
Thank you, sir. Thank you.